In 2025, Ghana launched one of the most remarkable economic campaigns in modern African history, a full-scale war against the US dollar. Today, we examine how a nation battered by debt default and economic crisis weaponized its gold, defied international pressure, and attempted to rewrite the rules of currency sovereignty. This is the story of Africa's boldest currency battle.
Cedi has slumped to become the world's worst performing currency. The cedi has lost more than 45% to the dollar since the beginning of the year. According to Bloomberg, Ghana's currency has overtaken Sri Lanka's rupee as the world's worst depreciated currency.
To understand Ghana's dollar war, we must first understand the traumatic economic event that preceded it. Ghana, once hailed as Africa's economic superstar, found itself in 2022 facing its worst economic crisis in decades. The cedi had lost over 28% of its value against the dollar in 2024 alone. Inflation skyrocketed to nearly 24%. The country lost access to international markets, and in 2022, Ghana defaulted on its massive public debt.
Ghana's consumer price inflation accelerated to 23.6% year-on-year in April, the Statistics Service said on Wednesday. That's up from 19.4% in March in a recent record that one economist described as shocking.
Ghana has suspended payments on most of its external debt, effectively defaulting as it struggles to plug its balance of payments deficit. The West African nation's finance ministry says it won't service debts, including its Eurobonds, commercial loans, and most bilateral loans. The country has been struggling to refinance its debt since the start of the year after downgrades by multiple credit rating agencies. Ghana has been experiencing what some say is its worst economic crisis in a generation.
The solution was a painful $3 billion IMF agreement in 2023. But the tension between IMF orthodoxy and Ghana's unconventional approach would define the coming dollar war. Ghana's most powerful weapon in its war against the dollar wasn't printed on paper. It was dug from the ground. As Africa's largest gold producer, Ghana experienced a historic surge in gold exports at precisely the moment it needed it the most. Gold shipments reached approximately 11.6 billion in 2024, a massive 53% jump from 2023. But the rare explosion came in earlier 2025, with gold exports surging to $2.7 billion in just the first 4 months.
Ghana's small-scale gold exports soared to $2.7 billion from January to April 2025. That's according to newly released data from the Ghana Gold Board. This marks a major jump compared to the same period last year, when earnings stood at just under $900 million. In 2023, the figure was even lower, around $400 million for the first 4 months.
This wasn't just increased production, it was a perfect storm of increased output and record global prices. But gold wasn't Ghana's only weapon. Cocoa, the other traditional pillar of Ghana's exports, also delivered an extraordinary performance. Cocoa exports revenue for earlier 2025 reached $1.84 billion, more than triple the previous year. This resulted from a strategic shift to the spot market, allowing Ghana to capitalize on record high global cocoa prices. This commodity windfall were complemented by strong remittance inflows and rising foreign reserves. This arsenal provided Ghana with unprecedented firepower for its upcoming currency campaign. With this arsenal of foreign exchange, the Bank of Ghana launched an unprecedented intervention. The numbers are staggering. After selling $1 billion across all of 2023, intervention rose to $3 billion in 2024. But this accelerated dramatically in 2025, reaching $1.4 billion in just the first quarter. The mechanism was simple economics. By flooding the market with dollars, the Bank of Ghana increased supply relative to demand. The results were dramatic. The cedi appreciated significantly, making it best performing currency globally. But evidence began emerging that the intervention might be creating distortions. Multiple foreign exchange rates emerged, a clear sign of market fragmentation. the interbank rate traded around 10 cedis to $1, while the retail rate was quoted around 12 cedis. This divergence suggested the intervention was creating artificial conditions that couldn't be sustained indefinitely. Ghana's aggressive strategy did not go unnoticed by the International Monetary Fund. In its program review, the IMF issued a clear warning that the Bank of Ghana should reduce foreign intervention or risk new economic instability. The fund's position was unambiguous. They urged Ghana to reduce its footprint in the forex exchange market and allow for greater exchange rate flexibility. This confrontation represented a fundamental philosophical crash. The IMF's orthodox belief in market-determined race versus Ghana's more interventionist approach. Faced with this pressure, the Bank of Ghana began a tactical retreat. Data shows a significant scaling back in both the size and frequency of dollar sales. The bank was even absent from the market on certain days, the first such absence since April. The immediate impact was predictable. Reduced dollar supply led to cedi depreciation again.
Through that entire phenomenon, we kept saying it, that there wasn't a specific exchange rate that we were targeting. Remember, the exchange rate, as we always say, is an endogenous, variable. It must move. It can move by the minute, it can move by the second, it can move by the day. And that is the framework we have, what we call a flexible, a managed floating system. That is what we maintain. Now, when a currency appreciates sharply, it brings on board other phenomena. And we are beginning to see some of those phenomena at play. For example, immediately imports become a lot cheaper. And so you find that people who wouldn't have been settling their import bills that early, they find it cheaper to do so. And so it's just natural to begin to see pressure build up on the currency just because of the sharp appreciation that occurred. So for us, what you see out there as pressure is just a cash flow. The macroeconomic fundamentals are very strong. As at the end of June, you saw all the numbers. Growth is strong. The external sector is very much viable. The current account is very strong. You've seen the surplus. You've seen the trade account. The balance of payment is as strong, strongest than ever before. And so in terms of the macroeconomics, nothing has changed. Things are actually looking good. Inflation is on the downward decline, as you know. And so ideally, there shouldn't be pressure on the local currency. Rather, what is happening is just because of the sharp appreciation, we were beginning to have some, some cash flow problems. Now, why specifically? Again, because we've seen some decline in terms of remittance inflows. That also I can explain the phenomenon at play. We've had some IMTOs and other remittance companies beginning to pull a fast one, beginning to use other channels. Over the last 2 months, for example, we have seen very limited interbank trading. And so you find that unless the central bank is there, supporting the market, then you would see pressure building up.
While battling the dollar in international market, the Bank of Ghana opened a second front domestically against the widespread practice of dollarization within Ghana's own economy. The phenomenon was pervasive. Landlords charging rent in dollars, car dealers pricing vehicles in USD, high-end retailers setting prices in foreign currency. This practice undermined the cedi's status as legal tender and creating a two-tier economy. The bank's response was stern, prohibiting on pricing, advertising, and receiving payments in foreign currency within Ghana.
The Bank of Ghana has issued a stern reminder to the public and businesses that unauthorized foreign exchange transactions, including black market dealings and dollar pricing, remain strictly prohibited under the Foreign Exchange Act 2006. In a public notice, the central bank warned institutions and individuals to cease the practice of quoting, invoicing, advertising, or making payments in foreign currency for goods and services unless duly licensed or authorized.
The message was clear. The cedi is Ghana's sole legal tender, and it must be treated as such. This domestic front was arguably as important as foreign interventions. By fighting domestic dollarization, the bank sought to reinforce confidence in the cedi and break the psychological preference for dollars. The combined effect of Ghana's dollar war was a dramatic transformation of its economic landscape. Inflation fell from 23.8% to 18.4%, the slowest pace in more than 3 years. Companies reported outright monthly reductions in both input costs and selling prices for the first time in 5 years, a tangible benefit that reached everyday Ghanaian. On the fiscal front, the cedi's strength provided unexpected relief. Ghana reduced its total debt by almost 150 billion cedis, a reduction the president called very significant.
One of the push factors for the debt is the strength of the value of the local currency. Our debt continued to multiply because the cedi continued to grow weaker, and so you needed more cedis. Because our public debt is stated in cedis, the weaker the cedi becomes against the foreign currencies, the higher it pushes up your debt. Fortunately, some measures we put in place have recently begun to show results, and the cedi has been strengthening. And so we've reduced our total debt over the last 5 months by almost 150 billion cedis, which is very significant. And so if that trajectory continues, the target of reaching 55 to 58% debt sustainability by 2028 will be reached by the end of this year.
The stronger cedi effectively shrank the cost of the country's foreign debt, providing more fiscal breathing room. The intervention strategy, however controversial, had delivered measurable economic benefits. As we conclude our examination of Ghana's dollar war, we are left with a complex picture. Ghana's aggressive intervention strategy undoubtedly achieved its short-term objectives: a strong cedi, lower inflation, reduced debt burden, and improved economic confidence. But the fundamental question remains, is this strategy sustainable? Critics point out that Ghana's dollar war has been funded by commodity windfalls, and that could reverse quickly. The IMF's concern about over-reliance on intervention hasn't disappeared. The true test will come when either global commodity prices decline or domestic political pressure conflicts with long-term discipline. Ghana's dollar war represents a fascinating case study in economic sovereignty versus orthodoxy, intervention versus market force, short-term gains versus long-term stability. The final chapter of this story hasn't been written yet, but one thing is certain: the world will be watching to see whether Ghana's bold strategy ultimately succeeds or serves as cautionary tale about the limits of fighting market forces. And that is all for today's episode. Please let us know your thoughts and suggestions on this in the comment section below. Thank you very much for joining us on this special report. My name is Sharif Haruna, and this is AS1 Report. Have a joyful life and see you in the next one. Macroeconomic.